Most people think getting a loan for a real estate investment works the same way as getting a mortgage for their home. It doesn't. And if you walk into the wrong lender for the wrong deal, you could lose the deal entirely. Today, we're breaking down the entire world of real estate lending in plain English. No jargon, no fluff. Just what you actually need to know as an investor. Welcome to Clear to Close REI. Before we talk about specific loan types, you need to understand one big idea. Real estate lending is a spectrum. On one end, you have banks. On the other end, you have hard money lenders. And in the middle, there's a whole world most investors never even know about. Where you land on that spectrum determines your rate, your fees, your closing speed, and ultimately whether you get the deal done. Let's walk through it. Let's start on the left side of the spectrum. Traditional banks. We're talking big national banks, regional banks, credit unions. The places most people think of first when they hear the word loan. Banks offer the lowest rates and the lowest fees, period. But banks have the most intensive underwriting process of anyone in this space. They want to see everything: your tax returns, your W-2s, your debt-to-income ratio, your credit score, and they move slow. We're talking 30 to 60 days to close, sometimes longer. For a real estate investor, that's a problem. Good deals don't wait 60 days. Now let's go all the way to the other end of the spectrum. Hard money lenders. Hard money is about one thing: speed. These lenders can close in days, sometimes a week. They don't care much about your income, your tax returns, or your credit history. They care about the deal, the property, the numbers. If the asset makes sense, they'll fund it. That speed and flexibility comes at a cost, though. Hard money rates are high. We're talking double digits. And the fees can stack up fast. Hard money is a tool, a very specific tool. It's built for investors who need to move fast, who are flipping a property, or who need short-term financing. It's not a long-term strategy, it's a sprint. Now here's where it gets interesting. The middle of the spectrum, private lenders, sometimes called non-bank lenders or alternative lenders. This is the part most investors don't know about. And honestly, it's where a lot of the best options live. Private lenders are companies that lend their own capital to fund real estate deals. They're not banks. They're not hard money shops. They sit right in the middle. Their rates and fees are higher than a bank, but not by as much as you'd think. And in exchange for that small premium, you get speed, flexibility, and common sense underwriting. Private lenders can close in 2 to 3 weeks, sometimes faster. They work with loan types banks won't touch. Things like DSCR loans, bridge loans, fix and flip loans, ground-up construction. If you're a real estate investor, private lenders are going to be your most common partner. So, let's bring this all together. The lending spectrum looks like this. On the left, banks. Lowest cost, slowest speed, most paperwork. On the right, hard money. Highest cost, fastest speed, minimal underwriting. In the middle, private lenders. The sweet spot for most investors. There's no universally right answer. The right lender depends on your deal, your timeline, and your strategy. Knowing the spectrum means you always know your options. And in real estate, options are everything. In the next video, we're going deep on one of the most powerful tools in the private lending world, the DSCR loan. If you found this helpful, hit subscribe. We're building out the full playbook here at Clear to Close REI, one video at a time. See you in the next one.